Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So our mission today is really to dive deep into three major global financial currents that are shaping things as we head towards the end of 2025. We want to give you a clear shortcut to being genuinely well-informed. We're going to be touching down in Washington, D.C., then hopping over to the buzzing markets in Mumbai, and finally looking at the really quite complex financial situation in Seoul.
Precisely. And we've been digging into sources that, despite all the global volatility we keep seeing, they show that institutional structures and, frankly, some very clear policy signals are creating distinct opportunities and risks, of course. So, yeah, we'll unpack the crypto acceptance story in the U.S., quite surprising politically. Then there's India's Goldilocks market surge. And finally, this really odd financial paradox in South Korea giving foreign investors what looks like free insurance. These aren't just, isolated events. They show where smart money is placing its longer-term bets.
Okay, let's kick off in the U.S. then, because the political energy around crypto, it's really picked up pace, hasn't it? We know the Trump administration has taken a notably supportive stance. And there was that very symbolic move this past summer.
Ah, you mean the pardon of Yeehee, the Binance co-founder?
Exactly. Sources pointed that out as a kind of political gift to the crypto world, with the president mentioning many good people in the industry. It sent a message.
It certainly set the tone, but it's the more recent rhetoric that really confirms this structural shift. You hear the president promising to ease what he calls excessive regulations that, in his words, suffocate crypto innovation. It's a clear play for support from crypto folks.
So it looks like a commitment to a lighter regulatory touch, administratively speaking.
That seems to be the direction, yes.
But political wins are one thing. Wall Street is where the rubber really meets the road. And the big institutional move happened mid-October, didn't it, with JPMorgan Chase?
That was the big one. They didn't just talk about Bitcoin and Ethereum, they actually made them officially recognized assets for collateral.
Which is huge, right? It moves crypto beyond just something you trade.
Exactly. It makes it a leverageable asset. JPMorgan launched this service initially for institutional clients like hedge funds and asset managers, allowing them to take out loans using their Bitcoin and Ethereum holdings as collateral. Think about it, if you're a big fund, this lets you unlock cash from your digital assets without actually having to sell them.
Okay, but how do they actually do that? Because banks are under huge pressure with capital requirements, like Basel III. Holding crypto directly sounds like it would trigger massive reserve needs.
Ah, yes. And that's the clever part. That's the key innovation here. JPMorgan isn't holding the Bitcoin or Ethereum directly on its own balance sheet. That would trigger those heavy capital charges you mentioned.
So what's the workaround?
They use trusted, regulated third-party custodians. Think firms like Fidelity Digital Assets or Coinbase Custody. They're the ones who actually hold the crypto.
Ah, I see. So the client's crypto stays in a specialized secure vault run by someone like Fidelity.
Right.
And JP Morgan issues the loan based on that crypto being held securely elsewhere. It's kind of like renting a super secure vault instead of building your own giant fortress.
That's a great analogy. It insulates JPMorgan from the direct storage risk and, crucially, the Basel capital hit. This separation is what makes it scalable for big institutions. The bank earns fees, gets the collateral backing, but avoids that heavy regulatory weight of direct custody.
And it seems like the model's catching on.
It is. Our sources say Goldman Sachs is planning something very similar, aiming for a launch before the year is out.
Okay, so the big question for listeners. Institutions are now using crypto as collateral. Does that automatically mean Bitcoin and Ethereum prices are about to shoot up?
Not necessarily, no. And this is an important caveat. JPMorgan Service uses crypto that clients already own. It makes that crypto more useful, provides liquidity, sure, but it doesn't directly create a huge wave of new buying demand overnight.
So the immediate price bump might not happen. Where's the real opportunity then?
The real long-term play, the strategic angle, isn't betting on the immediate price of BTC or ETH. It's more like the gold rush analogy.
Ah, the picks and shovels play.
Right.
Selling tools to the miners.
Exactly. The digital asset infrastructure. When institutions start using crypto like this, demand just explodes for the regulated companies providing the essential background services. Think about institutional-grade valuation who reliably prices this stuff in real time. Secure custody, obviously, and prime brokerage services built for digital assets. So if you're looking for the growth story here, watch the metrics for these service providers, transaction volumes, assets under custody, not just the token price itself. That's the more durable structural trend.
That idea of structural growth leads us perfectly to our next topic, India. A market where, underlying strength seems to be just shrugging off global worries. Sources are showing Indian indices, the Sensex and Nifty, are hovering near all-time highs. That's quite something given the global picture.
It really is spectacular, and a lot of it seems domestically driven. We saw that very clearly during the recent Diwali festival period. Consumption spending didn't just meet expectations, it blew past them, setting records, especially in things like online shopping and car sales.
Which points to potentially very strong Q4 earnings for companies focused on the Indian consumer, right?
Absolutely. That kind of consumer confidence is a powerful engine.
But what makes this really interesting and maybe more sustainable than just, retail excitement is the return of big global money, the foreign institutional investors, FIIs.
That's the crucial signal, yes. FIIs were massive net buyers. In October, we're talking close to $3.5 billion net. This isn't just traders dipping in and out. It signals a fundamental reallocation of global capital towards India.
Why now? What's the big draw?
It's what investors are calling the Goldilocks appeal. You've got this combination of factors that's very attractive right now, relatively low inflation.
Hold on, low inflation with record consumption and strong growth. How does that work? Usually that spells overheating. The last print was around 1.54%, wasn't it?
That's a fair point. It seems low, almost counterintuitive. The low headline inflation figure is partly due to stable food and energy prices, which the government has worked hard to manage. But perhaps more importantly, it reflects confidence in policy stability. Investors seem to believe the government's reforms and the central bank's credibility will keep growth going without letting inflation run wild.
So stability is the key ingredient.
It's the most valuable commodity in this environment, yes. So you have low inflation, solid GDP growth, and that predictable policy environment. That's the Goldilocks mix.
In connecting this to the bigger picture, how much of this is about investors looking away from China, the whole China risk narrative?
Oh, significantly. Sources emphasize this. Growing U.S.-China friction, plus structural economic headwinds within China itself, means global capital is actively seeking a large-scale alternative investment hub in Asia. India is increasingly seen as that strategic, long-term alternative. It's becoming a core holding in emerging market portfolios now, not just a tactical bet.
So for listeners thinking about this trend, where should they focus? If stability and domestic strength are key, where's the alpha, the opportunity?
It's overwhelmingly domestic. You want exposure to that massive engine, the 1.4 billion consumers. So think about strong private banks. They're crucial for credit growth. Then auto companies, consumer goods firms, retail distribution networks. These are companies plugged directly into rising local incomes, less dependent on shaky global exports.
And beyond just consumption, there's that longer-term story too, the supply chain shift. Make in India 2.0.
Correct. That's the multi-decade structural play. Global companies are actively, strategically diversifying manufacturing away from China. India is attracting more sophisticated parts of the supply chain now. We see it with Apple's suppliers expanding there, and critically, in areas like pharmaceuticals. India is strengthening its position in API's active pharmaceutical ingredients.
APIs being the core chemicals that actually make medicines work.
Exactly. Producing those requires significant technical capability. So attracting that kind of manufacturing builds a really deep, durable foundation for future growth.
Okay, so we've got political structures enabling crypto in the U.S., stable policy boosting India's domestic economy. Now for the final piece, this really weird situation in Korea, the free insurance paradox.
Yeah, this one's fascinating. It's genuinely unusual in global finance right now. Essentially, foreign investors looking at South Korea can buy insurance against the Korean won, weakening against the US dollar. That's called selling the won forward, basically, for zero cost. Sometimes they even get paid a tiny bit to do it.
Right. It's like being offered free, comprehensive insurance on a high-risk car. Your first thought is, what's the catch?
Exactly.
Because normally, hedging currency costs money, doesn't it? Especially with the big interest rate gap between the U.S. and Korea. U.S. rates are much higher.
They are significantly higher. And normally, yes, that rate difference means it should cost you something to hedge effectively. You're borrowing the cheaper currency, won, to invest in the higher yielding one, dollar. So selling one forward should have a cost reflecting that gap.
So why has that cost vanished? What's causing this inverted currency curve?
There are a few factors, but the biggest one, the one everyone points to, is intervention fear, plain and simple. When the Korean won gets close to that psychologically important 1400 level against the US dollar, the market just assumes the Korean authorities, specifically the Bank of Korea, BOK, will step in forcefully to stop it weakening further.
So the market thinks the central bank will defend the currency, making insurance against weakness seem, well, unnecessary, so the price drops to zero.
Pretty much. The perceived risk of a sharp won depreciation beyond that level is minimized because everyone expects intervention.
Are there other factors involved?
Yes, two others worth mentioning. Second is structural bond flow. There's consistent foreign money buying Korean government bonds, KTBs. Those bond investors naturally need to hedge their currency risk, creating steady demand to sell won forward. And third, the BOK's own stance. They're keeping interest rates steady, mainly because of domestic worries, inflation, high household debt. This signals to the market that the big interest rate gap with the U.S. isn't likely to close quickly, which also feeds into the forward pricing anomaly.
Okay, here's the paradox, though. If foreigners can hedge their Korean investments for free, you'd expect them to be piling into Korean stocks, right? The free hedge should act like an accelerator.
Logically, yes.
But sources noted that foreign investors were actually net sellers of Korean stocks in October. So what gives?
It tells us something really important. Hedging is necessary, but it's not sufficient. Even with that tempting free hedge on the table, bigger global fears about a potential U.S. government shutdown back then, ongoing trade tensions, those were powerful enough to make investors pull back. Global systemic risk trumped the local hedging advantage. It shows investors were more concerned about the overall economic climate hurting company earnings globally than they were excited about the zero-cost insurance.
So the free hedge itself is a kind of warning signal then, that something's out of balance.
Absolutely. It's not normal. It signals a distortion, either because of those extreme intervention expectations or specific supply-demand imbalances, like the bond hedging flow we mentioned. It means risk isn't being priced properly in that forward market. And investors need to be ready for this temporary situation to unwind. When it does, maybe intervention fears fade or the rate gap narrows, the currency curve could snap back quite violently, the free lunch could disappear fast.
So strategically, if the market is betting so heavily on the BOK keeping the won stable around that 1400 level,
Yeah.
is there a short-term play there?
Potentially, yes. If you believe the authorities will succeed in keeping the won relatively stable, you could look at companies that benefit from that stability. Think high importers, companies that buy a lot of goods or materials in US dollars, like airlines needing fuel or utilities buying equipment. A stable or slightly stronger won helps their bottom line, but it's a strategy that's very dependent on the central bank continuing to act as expected.
That wraps things up really well. So just to pull the threads together, we've seen political alignment in the U.S. opening the door for institutional crypto infrastructure, policy stability, and a massive domestic consumer base fueling India's rise.
Right.
And these hidden, almost strange market dynamics creating distortions and warning signals in Korea.
And I think the common theme across all three, interestingly, is that the most valuable asset isn't necessarily the underlying Bitcoin or the Indian stock or the Korean bond itself. It's the institutional trust and the regulated structure around those assets, whether that's the third-party custodians making crypto safe for banks, the stable policy framework underpinning confidence in India, or even the central bank's perceived power to stabilize the currency in Korea. It seems the future really lies in finding ways to manage uncertainty through reliable structures, rather than just ignoring the risks.
Don't forget to subscribe and hit that like button.